All right. Thank you everybody for coming to today's Indiana Moneywise program. Today the subject is investing. Kelly from the Secretary of State's office will be hosting today's program for the Lawrenceburg Public Library District. And there's a couple more programs coming up later this year, so just stay tuned. And I will take it and give it over to Kelly.
Thank you so much, Denise. Yes, my name is Kelly Greasy, and today we're going to kind of give everyone a crash course in the subject of investing 101. And the reason why my office is involved in this, I just want to give everyone a little background in case you missed our last presentation, which is available online. But the Indiana Secretary of State's office is responsible for regulating the investment industry in the state of Indiana. And so all of the people and products in the investment industry, those are regulated by us. We call them securities. The Indiana Securities Division is where I work. And part of our outreach effort to protect investors in the state of Indiana against investment scams, investment fraud, is to educate people about just the basics of investing. Now, I do want to stipulate here off the top that I am not allowed to provide any kind of investment advice. All the people and products in the investment industry that we regulate. And so we try to make sure that investors are kept safe by educating them about these products. And because I am someone who works for a regulator of this industry, I can't tell you who to invest with. I can't tell you what kind of products are best suited for you. All I can do is educate you about the people and products in this industry and help you make the best decision for yourselves. So with that, let's go ahead and dive in. And there we go. So to start our conversation about investing, I want to pass along 5 tips for success. And these are pretty straightforward, but they really are important. And the first one is make investing a good habit. So you want to start as early as you're able to and contribute regularly. An easy way to do this is to make saving automatic. For example, I get paid via direct deposit. Much of my paycheck goes into a checking account so that I can use it to pay my bills. But 10% of every paycheck goes into a special savings account that I don't touch until I'm ready to see my investment advisor and put that money into a Roth IRA account. That is just one example of how I save, but everybody is going to do this in a different way. Find a way that works for you and find an amount that works for you to just start getting in the habit of setting that money aside and not touching it. Step number 2, you want to set exciting goals. And so instead of a vague goal like financial security, you want clearly defined goals like $500,000 net worth by age 60. You need to put a price tag on your goals. You need to make them specific. And this is going to help you achieve the goals that you set forth for yourself by developing a strategy to reach them. You don't want to take unnecessary risks. Now, risk is the chance you take that you will lose money or that your money will lose value by earning less than the rate of inflation. We all have different levels of risk tolerance, and you should be investing based on your personal preferences and your ability to kind of absorb that risk if there is a loss. You want to keep time on your side, and that's where we talk about the time value of money. This relates to compound interest, and investing early gives your money more time to grow. The 5th step is to diversify. Well, we've all heard that phrase, don't put all your eggs into one basket. No investment performs well all the time, so you should spread your investments around to reduce risk and increase your overall return. So let's talk a little bit more about that process of diversification by taking a deeper dive. This process minimizes the damage or the danger posed in an up or down market. When one thing is down, another tends to be up. Your investment mix should take into account your risk tolerance. So also includes your age, your income, and your investment goals. Now, the graphs on the screen are only some examples of how you might diversify. If you work with an investment professional, they can help you diversify your own portfolio to minimize risk as you age. Because as the graphs show, if you're more than 10 years away from retirement, you can afford to take some more risks. But as you approach retirement or once you are in retirement, you want to minimize the risk where possible because you don't have that time horizon to make up for any kinds of massive swings in the market later on. So I did mention time horizon, and that is a part of the success of involving timing of your investment strategy. When do you need your money? Is it for income now, or do you want to let your money grow for many years to come? If you have some money, you will, or excuse me, if you have some money you will not need for several years, you might consider investment options such as stocks, bonds, or mutual funds. On the other hand, if you think you need access to your money right away, for example, you need it to be liquid, is a term we use, it might be best to keep it in a regular savings account where you have immediate access to it. These decisions can impact your time horizon, which is the length of time before you need your money. The longer your time horizon, the more risk you can afford to take. And that's a point that we're going to get into more here in just a moment. So, risk tolerance, regardless of your time horizon, you can't afford to greatly exceed that tolerance for risk. You won't be able to profit from investments that cause you to lose sleep at night because you won't be able to stick with them. The urge to sell will just be too great. All investing comes with some risk attached. Now, risk refers to the degree of fluctuation in an investment's returns. The greater the fluctuation, the greater the risk. Risk and return, they go up and down together. A low risk investment is likely to result in modest gains, while a high risk investment has the potential for much higher returns. A diversified portfolio will include both. And as you approach retirement, again, you want to reduce that risk. Now, if a seller tells you that an investment has zero risk, they are flat out lying. And if they claim to have high returns with a low risk, they're also lying. Risk and reward, again, go up and down together. Now let's look at some of the types of investments out there. And again, a reminder, I'm not recommending any particular kind. I'm telling you what's out there and available and how these different types of investments work so that you can make the best decision for your life and your needs. Most people think of stocks when they hear the word investing, but there are actually a lot of different investment products out there. This is just a list of some of the most common types: money market accounts, bonds, stocks, mutual funds, retirement investments that are set up by your office. Some people think of annuities as investments, but they are not regulated by the Indiana Securities Divisions because annuities are an insurance product. So if you want to know more about annuities, you would want to check with the Department of Insurance to get some more information about that and how they are regulated. Now, money market accounts are one of the more popular products out there. This is how they work. A money market fund is a low risk, low return investment. Again, risk and reward go up and down together. So you're at the low risk and low return. They invest in high quality, very short term loans with maturities of 13 months or less, such as treasury bills and certificates of deposit. The U.S. Securities and Exchange Commission, or the SEC, requires that the average maturity of a money market fund be no more than 90 days. Money market funds can provide income, but they don't provide any capital gains. Now, ideally, there are no fluctuations in a money market fund's shares. These funds are managed with the goal of maintaining a stable share price of $1 per share. There are no guarantees, however, and shares of money market funds occasionally do dip below their $1 value. In most instances, the funds of these sponsors have absorbed the resulting losses rather than pass them on to shareholders. And so sometimes what I'll get after doing a presentation and I tell folks there's no such thing as a no risk investment, they'll bring up these so-called no risk investments of money market accounts. Again, there is a chance that it will lose its value, but in these kinds of situations, the way they're sold by the people who handle them is that the company absorbs that loss and doesn't pass it on to you as the seller. So this might be a product that gets billed as no risk, but it's just that someone else is paying for that loss. Bonds are another type of investment option out there. Now, they would be considered low to moderate risk with low to moderate returns. The most common type of security in financial markets, actually. Bonds are loans that investors make to the federal government, state governments, and to corporations. The loans may have a lifetime of anywhere from a few weeks to 30 years or more. So there's a lot of variation there in the time horizon. Now, if you have in the return for the loans, investors receive an interest payment, which is called a coupon payment. This interest payment is the sole source of return on bonds that are held for the life of the bond. Bonds that are sold prior to the maturity may also generate a profit if the bond sale price exceeds the price you paid for the bond. This profit is called a capital gain. Bonds have declined in price, or bonds that have declined in price result in a loss called a capital loss, were you to sell them prior to the bond's maturity date. Now, the biggest risk factor that's associated with bonds is their credit quality and remaining time to maturity. Bonds with a low credit rating indicate that the financials of the company issuing the bonds are shaky. This can inhibit the company's ability to make timely interest payments or to repay its loans. Bonds with long maturities, like 7 years or more, will incur the biggest price changes when interest rates change. So bond prices move in the opposite direction of interest rates. Now let's talk about stocks, what most of us think of when we think of investing. So stocks generally have the potential for high risk and high returns. Again, we're going up now, risk and return going up together. Stocks are shares of ownership in a company, and their performance depends mainly on how well the company does. Now, as a company expands and prospers, people recognize its increasing value and they're willing to pay a higher price for the company's stock. And you see this happen a lot when you hear about a company's valuation in the stock market and how it's performing. This allows stock owners or shareholders to sell their stock for more than they paid for it, thereby producing a profit or capital gain. Some companies also share a portion of their earnings with stockholders each year. These distributions are called dividends. They provide shareholders with annual income. The biggest risk factor associated with stock investing is in trying to determine the likelihood that a company's projected earnings and dividend growth will materialize. Earnings and dividend disappointments can cause significant declines in a company's stock. You can reduce the impact of a company's disappointing earnings and plummeting stock price by diversifying your portfolio across companies in a wide variety of different industries. Now we're going to look at mutual funds. Mutual funds entail a wide range on risk and return, depending on what kind of securities the fund invests in. A fund is created when an investment company pools the money of many individuals to purchase stocks, bonds, or other types of investments. Some mutual funds even invest in other funds. In return for the money that they commit to the pool, investors then receive shares in the fund equal to their contribution. The value of these shares fluctuates daily, reflecting the changing value of the securities in the fund. A fund's returns, may emphasize income, as in the case with income funds, long-term appreciation, which is primarily the case for most stock funds. So there's a lot of variety out there when we're talking about mutual funds. In addition to the types of securities that funds invest in, there are other factors to take into account when assessing a mutual fund and whether or not it's right for you. The returns that a fund generates relative to the risks that it takes. The best performing funds are those that generate the greatest returns for the risks that they take relative to other funds in their categories. Another factor is the length of time a fund's manager has been with the fund. Now, an outstanding 5-year record of a fund is meaningless if the manager has only been with the fund for a few months. So that's some information that you want to know before investing. The fees and expenses associated with the fund are another big category that you need to be looking at. The higher an interest or an investment's costs in terms of both sales and ongoing management fees, the lower the return of your investment. So you need to pay close attention to those fees, especially the ongoing ones and the management fees. Retirement investments are the last type of investment that I'm going to talk about, but these actually make up a really big portion of what a lot of Americans are invested in through their work. Retirement investments accrue interest over a long period of time so that you have money to live off when you're no longer working. There are several investment products out there designed to help you save for retirement. individual retirement accounts known as IRAs, 401k and 403b plans, and then variable annuities, which I won't really get into too much. Individual retirement accounts, or IRAs, are the most basic sort of retirement arrangement. Um, if it is held by an insured financial institution, it is insured up to the maximum allowed by the law. So you will want to talk with your tax advisor for more details and or a review of the IRS publication about these types of products. A traditional IRA is when a personal savings plan gives you tax advantages for saving for retirement. Now, contributions to a traditional IRA may be tax deductible based on the amount of your contribution and your income. With a traditional IRA, you don't pay the taxes up front. Instead, you pay when the funds are distributed. So you're going to be paying the taxes on your investment when it's time to retire, or whenever you cash out your IRA. The portion of contributions that was tax deductible is also not taxed until distributed. And a traditional IRA can be established at many different financial institutions, not just through work. So if your work doesn't offer one, you can go to your bank, you can go to an insurance company or a brokerage firm in order to get that. Under an IRA, a traditional IRA, an investor can put aside up to $5,000 per year. And then that's actually a little bit changed depending on your age. I think you can start to contribute a little bit more as you're older. Earnings accumulate again on a tax deferred basis. You pay the taxes after the fact with a traditional IRA. A Roth is the opposite of that. It's the same in terms of it being a personal savings plan, but it operates in the reverse of a traditional IRA. So contributions to a Roth are not tax deductible contributions. Instead, you're paying the taxes up front. But that means that when the money is distributed later, you don't have to pay the taxes. You pay it in the beginning. For a lot of young people, a Roth IRA is a good deal because they're being taxed at a lower income tax bracket when they first start contributing. So they're able to save more money in that regard and not have to pay higher taxes when maybe they're in a higher tax bracket when they retire. So for a lot of people, a Roth is an attractive option when they're younger. Um, excuse me. A Roth can be established at the same types of financial institutions as a traditional IRA. So if your office doesn't offer it, you can go to your bank, credit union, whatever, to get a Roth IRA set up. It has no deduction for contributions. However, if you meet certain requirements, all your earnings are free of taxes to you or your beneficiary when they are withdrawn. Now, 401k and 403b plans, which is what a lot of people have through work. The 401k is a retirement savings plan established by an employer that lets its employees set aside a percentage of their pay before taxes are taken out. Often employers may make matching contributions. And so if your employer offers matching, you should definitely take advantage of that. That's free money that's on the table that you don't want to give up. A 401k is tax deferred retirement plan that allows an employer to match certain deposits into an up to a certain amount. With a 403b plan, this is a retirement savings plan similar to the 401k, but it's for employees of public schools and certain tax exempt organizations. Characteristics of a 401k and 403b plan include maximum contribution limit per year, a penalty on early withdrawal before the age of 59 and a half, except in certain circumstances, and they are portable. You can roll over your money with a new employer if you change employers. You may be able to even choose how to invest the money in your plan, depending on how it is set up at your office. So make sure that you talk with your human resources person about the options for a 401k or a 403b. Now, perhaps you need some experts' help in reaching your goals. Maybe this information is a little overwhelming and you want someone to help you get on the right path, or you've made some changes in your life that you could utilize the help of a professional. We all need an expert's help from time to time. A financial professional can help you succeed in saving for the future, and that's why it's key to select someone who is affordable, trustworthy, and compatible. Here are some of the times when it pays to seek professional guidance. If you've transferred jobs and you need help transferring your retirement savings to your new employer. If you're getting married and you need assistance in merging your financial lives. If you've inherited some money and you need direction on how to invest it. if you've lost money in your retirement accounts and you feel like a professional would help you make some better choices moving forward. Those are some great times to seek the help of a professional. There are several different types of financial professionals out there. I'm going to go over some of the highlight reel of these types of professionals. A registered representative is a professional designation known for, excuse me, is a professional designation for someone more commonly known as a stockbroker. Registered representatives are agents who buy and sell securities on behalf of their clients. They may be your first point of contact if you simply want to buy and sell stocks. Now, a certified financial planner, or a CFP, is someone who takes extensive exams in areas of financial planning, taxes, insurance, real estate planning, estate planning, and retirement. CFPs must also complete continuing education programs each year to maintain their certification status. Many CFPs specialize in certain groups of clients like retirees, singles, widows, small business owners, and career military. Registered investment advisors, or RIAs, manage or invest money on your behalf for a fee. Now, you may elect to give these people discretion to make trades in your accounts and create an investment strategy for you. RIAs provide advice, make recommendations, and issue reports on securities. They also have what's known as a fiduciary duty to their clients, which means they have a legal obligation to act in your best interest at all times. There are some other types of professionals out there. I'm not going to go into too much detail about these, but I want you to be aware of some other types of financial professionals, including these certified fund specialists. Now, they can be any type of investment professional who has completed a course on mutual fund investing. These specialists must pass a 2-hour exam and meet an annual 15-hour continuing education requirement. An insurance agent's main area of expertise is insurance products. So remember, we talked about annuities. That might be someone that you go to for annuities. Some agents may also advise clients on fund purchases. Insurance agents who provide investment advice may have the designation Chartered Financial Consultant, or CHFC, or a Chartered Life Underwriter, a CLU. To earn these designations, insurance agents must pass a series of tests on investing and personal finance topics, and they must also meet continuing education requirements. Now, certified public accountants, or CPAs, generally assist people with their taxes and with retirement planning, but some also specialize in investment advice and may have the designation of personal financial specialist, or PFS. Candidates for this designation must hold a valid CPA license as well as pass an examination on investing, estate planning, retirement planning. In addition, PFS candidates must also meet continuing education requirements. Even though investment advice may be incidental to the practice, accountants still need to be registered with the state of Indiana or with the Securities and Exchange Commission. Now, I want everyone to be very careful about any unfamiliar professional designations. When you encounter one that you're unfamiliar with, be aware, because there are people out there who make up fake types of designations in order to either get more money out of you or con you into any kind of scam that they might be running. You should research what is required to earn any given designation. And again, there are some designations that do not require licensing requirements. Someone may call themselves a CSA, or a Certified Senior Advisor. That's really not a professional designation. It's just a term that some people attach to the back of their name. So how do you go about picking a financial professional? Well, start by seeking referrals from family and friends. But you would never want to trust someone who is coming to you only from a referral. Never trust someone who cold calls you on the phone or emails you claiming to have an exciting investment opportunity. You want to do your research. You can visit the Indiana Secretary of State's website to search the database. This will tell you if the professional is registered with our office, and then you can get the professional's employment history, records of exams they've passed, and see whether there have been any customer disputes or regulatory actions against that person. You should also schedule some introductory meetings with the top candidates, and you shouldn't have to pay for this initial meeting. So here are some questions that you can go into that first meeting with. What is your training and experience? You want to know how long they've been in the business and what they did before. You are looking for someone who has been in business for several years and has the background to deal with your particular financial issues. Ask them about their investment philosophy and track record. You want someone whose investment philosophy is in sync with yours. And even if it isn't completely, you want to know that they're going to abide by your tolerance for risk and that they appreciate your opinions on how to handle your money. An advisor you're considering should be willing to give your references or should be willing to give you references of other clients or information on how other clients' portfolios have performed. If they're reluctant, that's a red flag. Ask them for a copy of their regulatory disclosure forms. Planners and advisors who are paid to give advice about investing in securities must disclose details about their investment style and philosophy, training, disciplinary record, fees, charges, and more. The best and most commonly used disclosure form is called Form ADV, which has two parts. Part one has information about the advisor's business and whether or not they've had problems with regulators or clients. Part two outlines the advisor's services, fees, and strategies. Now, you can view most advisors' most recent Form ADV at the SEC or FINRA's websites. And if you're not sure how to access those, you can always contact our office, the Secretary of State's office, and we have links to the different types of research databases on our Securities Division website as well. But these should be posted on the advisor's website in addition. And if they don't have them posted, you should at least be asking them to email them to you. You always want to check with our office, the Indiana Secretary of State's office, for complete information about advisors licensed in Indiana. You should be asking this person how your relationship will work. You want to know whether you can expect to talk to your advisor directly or more likely be interacting with a member of their staff. And how often can you expect to speak to them? Once a year, every 3 months, more frequently? Is the advisor willing to take spur of the moment phone calls? Will they respond to emails? How much do they charge? This is a big one because a lot of people aren't aware of all the different fees. You need to have an advisor be upfront with you about how they make money off of you. Financial advisors charge for their services in different ways by accepting commissions on the sale of specific products or charging fees, either hourly, typically $150 to $300, or as a percentage, generally 0.75% to 2% of your assets and management. There are also some that have a combination of fees, perhaps an hourly rate for consultations and then an annual retainer fee for general financial advice. They may charge for a percentage of your assets if you sign up to have the advisor manage your money on a regular basis. Any arrangement in terms of fees and how this professional makes money can work. You just need to be aware of and comfortable with the terms of the arrangement. So when you're getting started with an advisor or a planner, they are probably going to have you start with a questionnaire or write up a memo about your financial situation and expectations. Once hired, you will sign an account agreement, which sometimes is also called a client agreement, and this will define the details of your relationship with the professional. It is designed to protect you from unauthorized actions on the part of your advisor and surprise fees and charges. This agreement will include the following: a list of specific services, a breakdown of fees and charges, a list of information you're expected to provide, and a statement of liability. Here's how you protect yourself against con artists that are out there. Ask questions. Fraudsters are normally hesitant to answer questions, in part because it's harder to keep track of a lie if they're having to think on the fly like that. They like to keep to their script. Always ask for written information about the product. This could come in the form of something called a prospectus. Check with our office, the Indiana Secretary of State's office, to see if the professional and their product are registered. Finally, trust your gut. If it sounds too good to be true, it is. And now what I'm going to do is I'm going to put up a contact screen here for the Indiana Securities Division. You can see our phone number, our email, and our website there are on the screen. All of these can be also found on the Secretary of State's home website. So if you're unsure and you lose this address later, just Google Indiana Secretary of State and you'll be able to find us. Remember, it is important to investigate before you invest, and this includes knowing how the investment works, its return and risk characteristics, and the potential to impact on your existing portfolio. And again, this involves checking with our office and the SEC to make sure that the product and the professional are legitimate. And now I want to open it up if there are any questions, perhaps from Denise or our visitor today.
I don't have any questions. I thought it was very well presented, and I thought you were very thorough. Thank you.
Thank you. Yeah, happy to help. And our office is always willing to work with folks to explain things to them. There is a website that I very much enjoy called Investopedia. And this is a wonderful resource for folks. We have it linked in several places on our website as well. It has nice plain language definitions of anything and everything related to investing. So folks can check out Investopedia if they're looking to grow their knowledge about investing.
All right, great. Thank you very much, Kelly. I appreciate it, and I'm sure our patrons will too. And thanks for all you've done for us with the Moneywise program.
Thank you very much for having me.